Meanwhile, the banks have been the highlight front and center all week this week, reporting their quarterly earnings. Bank of America reported earnings earlier in the week. Fourth quarter profit was up 28% to $7.01 billion. That's 82 cents a share. Revenue was up 10% to $22.17 billion. That was beating expectations on revenue. Joining me right now is the chairman and CEO of Bank of America, Brian Moynihan. Brian, it's great to see you this morning. Happy New Year to you. Thanks for being here.
Happy New Year, Maria. Good to see you again.
How would you characterize the quarter, Brian? Assess business for us with your most recent earnings. What drove business?
Well, if you look at what Bank of America did in the fourth quarter, you just rattled off some of the statistics, $7 billion of earnings, good, done the right way with good risk management. But the interesting parts were, $50 billion of loan growth in the quarter, and some of it came from the markets business. But in the core middle market businesses, strong loan growth, consumer loan growth, which means customers are out there borrowing and doing things, which is terrific. We saw strong deposit growth. We saw record investment banking fees. The trading team did a good job. The fourth quarter is a weaker quarter in trading historically, but all in, the company had a great quarter and a great year. And I thank my teammates and for the great job they did serving our customers again during this interesting time of COVID and dealing with all the things we have to deal with on a given day.
Yeah, you're right. Challenges everywhere. And yet you've got these tremendous numbers. Brian, walk us through where the growth was, because for a while here, we were talking about the capital markets business doing really well with obviously all the mergers and acquisitions and trading. But the loan growth was just OK. This quarter was a bit different. You're actually seeing loan growth pick up speed. What are you expecting in terms of loan growth on the residential and the commercial side for 2022, Brian?
Well, Maria, we talked back in October after the third quarter earnings, and we talked about loan growth, and we were sort of an outlier starting to see it more. In this quarter, we again saw it faster than the market, and that's because, frankly, two things. One, a great client base, which is always the most important thing, but a great set of teammates are out there winning in the market, getting growth and driving it. But what does it say about the broader economy? If you look at what consumers did in the fourth quarter, the amount of money they spent was a record at Bank of America. And so we saw last year $3.6 trillion of spending. In the fourth quarter, it was up 30% over 2019's fourth quarter. So forget about 20. And in the month of December was strong, too. And even in January so far, in the first 3 weeks or so, we're seeing, first through the 17th, we're seeing that number hold up a double-digit plus growth, which means consumers have money. If you look in the bank accounts of our consumers, they have multiples because of the stimulus payments and their savings and what they've done during the pandemic in their accounts, and that's good. And then you're seeing the commercial borrowers, leave aside supply chains and other things which are difficult to deal with and getting employees. The reality is they started using their lines again, which means they're starting to build up inventories and raw materials to start to work and sell goods. And so the economy is strong. But look, our experts have it growing at 4% in 2022, but it starts to normalize in 23. And you're mentioning that that's the job to get the economy back to normal after it's recovered from the pandemic that the Fed has to do now.
Yeah, I mean, you make a lot of great points. I actually spoke with one CEO in tech yesterday, and he said to me, Maria, things worsened in the third and fourth quarter with regard to the supply chain. This chip shortage is not going away anytime soon. It's going to be an issue. We know inflation has been spiking. So, Brian, what are you expecting from the Federal Reserve? Look at these nervous markets. They're trying to figure out if the Fed's going to get it right, going from this easing position to now a tightening position. How many rate hikes are you expecting, Brian?
Well, if you go back to the start of the pandemic, the amount of fiscal stimulus and the amount of monetary accommodation hitting the economy all at once did its job, in that the economy right now is largely the size it was pre-pandemic. Unemployment's down below 4%. It was 3.6, it's now 3.9. Those numbers mean that the economy is fully recovered. That means the Fed has to normalize. If you think about 2019, where this Fed was with this chair and these voters, it had a 2% Fed funds rate. The economy was predicted to grow at 2%. The economy was this size. Unemployment was 3.6 or whatever it was exactly. And, that's what you'd expect. So the market expects, 4 Fed increases this year. We agree with that. Our research team, which is terrific, says 4 Fed increases. There's some expectation it may move faster because the inflation numbers are really large. But what that will do is start to bring the growth rate in the underlying economy back to normal. So if you think 6% for last year, 4% for this year, and 2% or so for the U.S. economy for next year, that's normalizing the activity, which is important to bring, to stop the potential speculative aspects and things that go on when money's too loose.
Yeah, look, everybody expected your expenses to go up, and we continue to see this pressure on wages and on competition for people. Brian, I want to get your take on all of this because am I right that you spent $36.1 billion on wages and benefits last year? That was up 10% from a year earlier. We've got this pressure on wages that has not let up at all. What can you tell us? You were the first, I think, of all the major banks to raise wages on tellers and the hourly wage, but you're seeing a lot of pressure from all sorts of positions right now. What can you tell us?
Well, it depends. The markets-related business, our financial advisory team and Merrill and our private bankers and private bank, their compensation structures are driven by the market, and the market lifts and the revenues of the business lift, and they had record revenues, $170 billion of flows into our wealth management platforms in last year alone. Those teams are doing a great job, so their wages lifted. And the investment bankers, of course, their wages lifted because they had a great year. 4 quarters above $2 billion in investment banking revenue, a record for the company. The trading had a record year last year, so of course that's up. But importantly, we have been on a task to make sure that we are the best place for employees to work. So our core employees have gotten high single-digit wage increases year after year after year. We're in our last year we did our fourth straight year of company-wide bonuses and company-wide stock. We continue to drive the ownership of our company towards our employees to give them a chance to participate in our success. So we believe this is broad-based. Now, when you go talk to our clients, wage growth and the inflationary aspects of wage growth and the pressure that puts on their margins is a very serious concern, and I think that's what the Fed has to start to work on. And the market's debating whether they get it right, but they have to work on getting the growth in the inflation and wages and the amount of wages, the growth in wage price type of things, to get it down to more normal. And that's their task ahead of them, and they're starting to engage on it, as they said earlier, late last year.
So Brian, what do you need at this point? I mean, do you need the same branch footprint that you've had in the past as these wages are going higher and pressuring all business to raise wages? How will you deal with that? We've talked about technology versus the branches in the past, but is this one of those tipping points where you take a look at whether or not you need that kind of a people footprint?
We started taking a look 15 years ago on continuing to be what we talk about is high touch and high tech. In our, consumer businesses, you have a dominant part of the activity is digital. As you get to relationship management businesses and wealth management and commercial banking and investment banking and markets, that has more people attached to it because clients want to have a one-to-one relationship. That is a value proposition. So it's very different for each one, but across the board, digital activity is skyrocketing. Last quarter, we had 2.7 billion digital interactions with our clients just in the quarter. Just in the quarter, Maria. We spend $3.5 billion a year on new technology code, with 10 or 12 billion to run the platform, and we spent that's all on new initiatives to generate new activity. Our Erica platform has 4 times as much activity going through it the fourth quarter this year versus fourth quarter 21 versus 20. So that digitization, but it's high touch and high tech. So over the next today, 200,000 or 300,000 people will come into our branches, and those great teammates will serve them well. So our job is to have the customer have it any way they want. So yes, there's much more automation, much more digitization. That's allowed us to go from 6,000 branches to 4,000 branches, round numbers. It allowed us to get more efficient. But on the other hand, our customer service has gone up, the size of our company has gone up, and we're growing faster in the market. That's a great combination, and that's what we're trying to achieve at Bank of America.
Yeah, I think you make great points. I guess what I'm trying to understand is how significant is the pressure on wages. I know that you've seen some advisors leave. How much pressure are you feeling to make sure to keep that top talent at B of A? Your biggest expenses, labor, and then there's tech. Bank of America spent $3.5 billion on new tech initiatives last year, but you've got the cyber issues there that you're continuing to spend big money on. Are you going to be doing more fintech deals?
Well, The way we do this is what we call operational excellence. So we drive principles we call responsible growth. Got to grow, no excuses. Got to do with the right risk. Got to be customer focused, and it's got to be sustainable. And one of the parts of being sustainable is operational excellence. So we work 2,000 ideas last year alone. We work to continue to improve the franchise, taking money out of work that can go away and putting the money into more people to serve our clients, more technology to serve them, and more wages for those teammates because they do a great job and deserve to get paid more. And yes, we're very competitive. Our attrition is basically where it was in 19, which was an all-time low for our company. And we continue to provide not only great wages, but great benefits, child care benefits, and things like that enable people to continue to work with young families, which is a lot of pressure in this. We provide commuting benefits, et cetera. All that is part of the package of who we are and what we do. And importantly, great starting wages, hiring lots of kids out of school, and frankly, the ability for health care in our company. Our teammates who are in the lower parts of pay have not had a health care premium increase since 2011. And we continue to keep that flat and continue to serve them well. And all that is what we do to be a great employer, and that's why we have a great team, and they do a great job for us.
Yeah, I'm glad you mentioned wealth management and the $171 billion there. What a great performance in terms of capital markets and what you're seeing in wealth management and new accounts, Brian. Let me turn to policy because we know that President Biden nominating progressive Sarah Bloom Raskin for the vice chairman of supervision. This is going to be the most important role in terms of overseeing the banks. And by the way, this is the wife of the Democrat House Representative Raskin. Your thoughts on how things will change? Remember what she wrote back in September, saying that while none of the regulatory agencies are specifically designed to mitigate the risks of climate-related events, she wants climate change to be a major priority for the banking sector. Your thoughts on how you'll be dealing potentially if she gets approved with this new bank supervisor and how that might change your spending, allocating capital toward climate?
Well, what we do overall is, look, Maria, I've said to you many times, we've been around as a company for since 1784 is the earliest part of our company, and there's been lots of regulatory schemes. We're charter number 2 when Alexander Hamilton was there. So, we'll be around. The story changes, regulations change, we adapt to them. It's what we in the industry have to do. But the key is to remember, over the last, since the great financial crisis in 7 and 8, the amount of capital in our industry, the amount of liquidity in our industry, the way the industry operates, allowed it to be, in the pandemic crisis, a source of strength for the American economy, supporting our customers with millions and millions and millions of consumer deferrals, supporting our customers with a panic borrowing and raising capital for them, and keeping the banking system open, frankly, when other things had to shut down. Every single day we operated. So I think people have to remember, no matter what the debate is about incremental changes and things like that, the core banking system in the United States is a pillar of strength, not only for the United States, but for the world. And I think that is the key. And so we'll whatever regulation comes up, whatever happens, we'll deal with. And so, that's the life as being a banker. And I think that's why we have these talented teammates that know how to work our way through whatever comes at us.
Brian, real quick before you go, it's been obviously a nervous market. We got markets down first 2 weeks of the year. Is this warranted? What kind of a 2022 are you expecting? Macro story, Brian.
Well, just look at our stock. We bounced down a little bit around earnings and everything going on, but we're still up for the year, 40% up for the last 12 months. So the market's been up a lot, and as the Fed slows it down and the economy slows down by design back to more normalized condition, of course the market's going to reflect that. So our experts have the S&P basically flat for the year, and we'll see how that plays out. But the reality is this is what the expected outcome of a change in monetary policy and change in fiscal policy, which had to take place because it had to be withdrawn now that the economy's recovered.
Yeah, for sure. Brian, it's great to see you. Congrats, and we will talk soon. Thanks very much for being here this morning.